Good morning, everyone. Welcome to our first session in a series of monthly webinars called In the Know. These webinars aim to keep you abreast of developments in both the local and international markets. In addition, we'll touch on our investment solutions, sharing our thoughts, positioning, and performance with you. We have just over 200 people attending today's session. It's an absolute privilege to be spending the next hour with you, and we thank you for choosing to spend your time with us. Before I introduce today's speaker, just some housekeeping. Please ensure your microphones are muted throughout the presentation and post any questions you would like our guest speaker to answer in the Q&A chat box. As we've allocated 10 minutes at the end of the session for some Q&A to ensure you get the most out of today's session. Today we have Patrice Rassou, our Chief Investment Officer in the hot seat. Patrice is the CIO at Ashburton Investments. He has a wealth of industry experience and is well known for managing market-leading equity unit trusts. He's a chartered accountant and holds a Master of Science in Economics from the London School of Economics and Political Science, and to boot, an MBA from Manchester Business School, cum laude. Without further ado, I hand over to Patrice.
Thank you very much, Steve, and good morning, everyone. As Steve has mentioned, I do have qualifications from the London School of Economics, and I've had a few of my friends telling me that in the black market, my qualifications are worth quite a bit. So I wanted to firstly show you that I do have a genuine certificate after the whole PhD saga that you've seen in the paper. But if any one of you want to make me a cheeky bid for that piece of paper, let me know. But without further ado, I'd like to kick off in terms of our first in the series of In the Know. And the idea is really to go through the various global asset classes, give you some insight of our thinking and how we analyze those, and also share our perspective of what's likely to unfold in the year ahead. So first, in the know. The word know in Greek can be two different words. Oida, which is I know because I've seen, which is very much the direct translation, or something which is very observable, or ginosko, which is to learn to know, which is more process over time. And at Ashburton Investments, we like to think of knowing as the whole ginosko process is a continuous process of learning. So first, let's look back on what's shaped financial markets in the past year. So there are many things which have impacted the world. There's two wars which are still raging in Ukraine and between Israel and Palestine. That's impacted the Straits of Hormuz and really is having an impact in terms of the global supply chain yet again. In South Africa, you all will be aware the Lady R saga caused a severe weakening of the rand. There's concern about the impact it might have on AGOA. We've had delays in ports. The Durban port itself, which handles 60% of all container traffic in South Africa, has been severely impacted due to faulty equipment. If you look at the whole collage here, economists were predicting big recession in 2023, which didn't happen, and we still have issues like load shedding, which is impacting us. So a lot has happened. Some of it is still relevant for the world of today and might still impact how financial markets evolve. That said, despite this quite grim picture, what happened to financial markets? And financial markets really has been a story of the Magnificent Seven. What are the Magnificent Seven? These are the biggest 7 companies in the NASDAQ. As you would know, the NASDAQ composite was up 43% last year. But I think what's important is to focus on these 7 stocks. So that's Meta, Apple, Amazon, Nvidia, Google, Microsoft, and Tesla. These group of shares grew their market cap by 180% last year. If you look at the non-Super 7 companies, the rest of the S&P 500, so the 493 companies, you can see they grew double digit, but it was a more in line with long-term growth averages. So that's been a big factor driving markets, and why I'm mentioning that to you is in terms of our investment strategy, we prefer to focus on stock picking. And when you focus on stock picking, you can still find in the global environment, global sector companies which are still offering reasonable value. And we don't have to buy into these very expensive growth stocks. So that is the one lesson from this. The other one is just to calibrate the Magnificent Seven. If these 7 shares, if we were to aggregate their market cap, they would be bigger than Canada, France, China, UK, and Japan's stock markets all put together. Actually, the Magnificent Seven would be the second biggest stock market behind the US and ahead of China if they were grouped. So just give you some perspective as to how large these companies have become. And the problem with that is obviously in terms of valuations being elevated, there's always a risk of disappointment if these shares don't continue to grow at the same pace as we've witnessed last year. So that's the one message here. So let's move on to the broader economic picture. As famously said by Sir John Templeton, the most dangerous words are this time is different. And we heard a lot of that last year and going into this year. So what is different this time? There's a certain belief that maybe the world can avoid a recession. Maybe there can be not even a soft landing, but no landing in the global economy. And why is that? The reason for that is global economies seem strong because the labor markets are very strong, especially in the US, which has been producing about 200,000 jobs every month. And that's led to basically strong demand outstripping supply. There's been also a supply shortage since the global COVID crisis, where some of the labor force exited. So strong economy. Does that mean the strong economy equals no recession? I'm showing you a chart here showing various instances of recessions. You look at the blue lines, and you can see every single time before the recession, unemployment tended to be at cyclical lows. So low unemployment doesn't equate no recession. And I think that's something to bear in mind and something we're watching quite closely. The other thing is I want to chat to you a little bit about the Phillips curve. Professor Bill Phillips was a professor in the 70s at the London School of Economics. So he invented, or he found, a relationship between inflation and unemployment. Basically, when you have low unemployment, you get more inflation, and the vice versa. When you have higher unemployment, less inflation. So there was a view in the last decade that central bankers were able to have growth, full employment, and no inflation. So basically, the Phillips curve was dead. And that whole thing changed in the past year and a bit. And yes, some of it was caused by supply chain effects, the war, but the reality is suddenly we had the revenge of the Phillips curve. We suddenly had a situation where low unemployment started to equate high inflation. And you can see the red dot here on the chart showing core CPI and the level of unemployment in the US. So there is no such thing as a free lunch suddenly. And I think the whole developed world started realizing that there is a trade-off. So this has led to the thinking that maybe the only way for the US to be able to contain inflation at their long-term target of 2%, they will have to stomach some unemployment. So the economy will have to slow. And an unemployment rate, if you look at this chart, will have to move from the low 3.4% towards more the 5, 6%, 7% level. So that's the other thing which talks to potentially the Fed having to engineer a recession to be able to hit its inflation target. And let's move on to what has been the impact of the quite historically high level of debt issuance in the US. So first, we go back to 3 years ago. In COVID, it was really the idea of the Federal Reserve and the rest of the central banks had to stimulate the whole economies by really doing an exceptional amount of quantitative easing and flooding the market with liquidity. The counter to that, it means that the level of debt issuance increased to a record level. So look at the chart on the left here, and you can see over the last decade and the one before how quickly debt has increased from 20 trillion to 30 trillion, now to close to $50 trillion. Last year alone, we had the second largest level of treasury issuance in history. I mean, previously it was 2020 at $1.8 trillion. As a result, you have excess supply, you have to be compensated for that. So in order for demand to come in, so you've seen we've moved from a zero interest rate policy to one where bondholders now can get a decent inflation risk premium. So again, the world, or the developed world, has moved from 0% interest rates to 3-4%, depending on the market that you're seeing. So the chart on the right shows you the average level of global government yields. So what's the implication of that? The implication of that is before it was the thinking of there is no alternative, Tina, there is no alternative. But now you have a risk premium in government bonds, even cash. You can get up to 5% in some short-dated US T-bills. So that is part of the asset allocations now that we would consider in our multi-asset funds, which before wouldn't be that attractive, thanks to the yield. So what did the Federal Reserve get wrong? So Jerome Powell in 2021 famously said he thought that inflation was transitory and factors which were putting pressure on inflation would wane over time. Again, if you look back for a short while, he looked like he was right. Inflation went to 5.5% in the US, then started declining to 5%. But then obviously, with the war between Ukraine and Russia, the oil price shot up to $120 a barrel, and suddenly inflation went on the other way around on the increase. So if you look at this chart, you can see June 2021 kind of started going up to 5, came down a bit, and then went all the way to 9, which really spooked the bond market. So for the developed world, it was really a situation that they hadn't experienced for over 4 decades in terms of the level of inflation and how rapidly it went up. So that forced the Federal Reserve and a number of central banks around the world to have to deal with that. So what is the current situation right now? So firstly, I think if we show you here US inflation with our own model looking forward as to what we think is going to happen over the next year, the red line is a combination of a number of factors. There's a Chinese deflationary impact. They export goods to the rest of the world, including the US, and that's actually going down. China is in deflation. And the oil price has come back a long way from what it was at 2022 at $120 a barrel. It's now trading around $80 a barrel. So we see the deflationary impact coming through, and that should help US inflation and global inflation to come down. There's also the delayed impact of higher interest rates. So we've had the fastest tightening cycle in the US. Basically, interest rates, if you look at the red line, went from 0 to 5% in a very quick period. You have to go back to 1980 to have such an aggressive and fast tightening in monetary policy. Back in 1980, in the 1980s, when interest rates went up by, as you can see on the chart, almost 7%. You had interest rates which basically went all the way up to 20% in the US. So this is also fairly unprecedented over the last 4 decades in order to combat the impact of this huge inflation. But again, in terms of forward-looking view, this is all behind us. So most of the work has been done from the Fed, and I think the Fed now is really ready to pivot, which is why for us the forward view is different from what you're seeing in the rearview mirror. But it's important to see where we're coming from to understand the view going forward. Also, you have global bonds, and especially US bonds, as a result of the higher inflation and higher interest rates, which halved over the last 3 years. This is again quite unprecedented. If you think of bonds, we all think of bonds as a safe asset class, as an asset class which basically behave, in a very predictable manner. I mean, very few people would have thought an investment in bonds after a long period of our performance. If you look at the chart, basically ticking up from 2003, few would have expected global bonds to halve. And this year, I mean, bonds did close up with a strong rally towards the end of the year, up 6%. But if it wasn't for that, it would have been unprecedented to have 3 years of losses in bonds. Again, that also for us means that global bonds, even at 4%, I mean, it's come down from the peak of yields of 5%. It does offer value if you think of it versus the long-term target inflation rate from the Fed at 2%. So there is a real yield which is now embedded itself in global bonds. And I'll bring that to our local environment as we follow. So talk about lies and statistics. I think here what is interesting is our process. So when we look at a process, I think it's important when looking at this investment clock, where do we find ourselves? I think there's been a bit of a growth phase. There's worry that we are in really an over exuberant phase, which can go into the red zone afterwards. I've mentioned already, if you look at some of the more expensive parts of the growth markets in the NASDAQ, I think some of that is already in exuberance phase. There are other alternative assets, if you are crypto probably in there, but in a lot of cases, as I mentioned, not everything went up or skyrocketed over the last year. And there are areas where if you can focus on stock picking, you can still find value in global equities, definitely value in our local market, and bonds, both local and offshore, given the yields that they're offering, also offering good compensation for risk, with inflation on top of that coming down and interest rates being cut going forward. So let's talk a little bit about South African CPI and AI. I'm not talking about artificial intelligence or the Magnificent Seven. I'm talking about avian influenza, which has been a big impact on food prices in South Africa. So we've seen food prices in South Africa increasing from going all the way to 16% over the last year or so. It's now starting to come down. That was the 7%. So if you look at South African CPI, it's slowly coming down towards the 5% level. That's the green line. And our model, which is in red, which takes into account some of these components, is pointing that downwards. So more volatile components in there from our model telling us that basically the inflationary impulse is definitely going down, which should help inflation go towards the middle of the 3 to 6% target band by the Reserve Bank, obviously, and that's always a key component that the Reserve Bank would look at before it starts cutting interest rates. Luckily for us, the South African Reserve Bank has been ahead of the curve, so we started hiking quite early in that circle, in that cycle, and really, if you look at the extent on the chart, this is a chart of short-term interest rates in South Africa, you have to really go back to the global financial crisis levels to get a similar level of nominal interest rates. So the Reserve Bank locally as well has done its job, and we think in terms of rate hikes, that's all behind us, and we are expecting rate cuts towards the middle of next year. So what does that mean in terms of the broader view on South Africa? Just like we spoke about the global picture, I think there's the short-term cyclical underpin of inflation coming down and rates coming down, and there's the longer-term secular issue of high debt levels and debt consolidation. So no different in South Africa. If you look at the chart on the left, where the red line shows the debt to GDP in South Africa at the budget, and then the medium-term budget was a negative surprise where debt to GDP spiked up. So obviously a big factor of that is lower growth from the number of factors which have impacted economic growth in South Africa: load shedding, port congestion, water shedding, and the like, which everyone's very aware of. But that also means that investors in our debt have demanded higher compensation for risk. So that is a combination of two things. One is, as the risk, I would call it the risk-free rate, or the developed market capital market instruments have offered higher yields. You know, if you are able to get yields of 4 or 5% offshore, then obviously you want more compensation for an emerging market like ours. That's one. And two, obviously, it's also looking at the current economic situation. So we've seen the South African bond yields on the right, the orange chart. Bond yields have peaked at 12%. It's closer at 11%. And really, just to put that in the picture, and this is showing you the chart, you have to go back to 2003 to get to a similar level of government bond yields in South Africa. And at that time, that was really the start of the Reserve Bank starting inflation targeting. So there's been a massive repricing, and the type of real yields that you get from government bonds, we think, is extremely attractive, especially on a risk-adjusted basis. The JSE, on the other hand, as you may know, this is an all-share index, hasn't done much for the last 2 years. It's been fairly flat. It's obviously underperformed the global markets, but it's also underperformed the broader emerging market peers, apart from maybe China, which I'll talk about more later. So I think a lot of it is self-inflicted in terms of our low growth and the issues we spoke about earlier, but it's also the money flow element. A lot of our people in the retail sector and the institutional sector have been disinvesting from South African assets to take those offshore. But I want to talk about one big reason for, especially if you look at the last year, why the JSE underperformed. One is China, and the Chinese economy has been hamstrung by the 3 Ds: debt, high debt levels, especially in the property market; deflation, where basically excess supplies versus demand, causing goods to deflate, prices to go negative growth; and basically poor demographics and aging population. The biggest population of the world, due to one-child policy, is not growing. So if we talk about the debt impact and the property market, the light blue line, you've had the real estate sector has been in free fall. Real estate is a very important asset class for households there. Many households have been first-time homeowners and have invested in speculative properties. So when that started going the other way around, and we've had companies like Country Garden hitting the wall, the market went into flat panic. Why is that important? floor space and growth in the property market has been a big driver of demand for commodities. And that has had a negative impact broadly on commodity demand and Chinese economic growth. Chinese economic growth, while it's still at just about above 5%, it has been the lowest it's been for decades now. So look at these two pictures, and I think you'll see the parallels. The orange chart on the left is our resources index. Our resources index were down 12% last year, you can see. And on the right is the Shanghai Composite, which also was down about 11% last year, but in dollars. What's also interesting is for over a decade, the Chinese market has gone nowhere. It's actually since China has been included into the MSCI or World Index, basically the market hasn't grown. So it's given up all these gains that it had through the big growth phase in the 2000s. So resources last year was a big factor dragging down the JSE. And if you look at commodity prices, that starts to give us a bit of a better idea of why that is. So gold has moved up. I think again with, you know, wars and concerns and risk aversion that's ticked up, and so have our gold shares. Copper, which is seen as a green metal for the green transition, has ticked up a little bit. You can see the red line, but platinum, the platinum group metals have really been hit hard. You can see platinum on the left, which is down almost over the last few years. You know, it's been a declining trend. But I think more importantly, which doesn't get spoken about much, is what rhodium has done, which is again part of the platinum group metals. You can see while platinum and palladium were down like 30 to 40%, and the shares have been down 30 to 40%. This rhodium has been driving really sentiment down. That metal alone, the green one on the right, is down 60% last year. And this year, the beginning of the year hasn't been great for platinum and palladium. They're both down by over 10% just in the first few weeks at the beginning of the year. So in terms of trade, our point here is we've been hit quite hard, but right now in terms of the levels at which we're seeing the PGM basket, we don't think there's a lot of downside from this point on. So that's probably positive, I would say, green shoot. The other thing is you're seeing the Chinese government has been quite slow to stimulate the economy in terms of cutting rates. It's got some measures that are expected to stimulate the stock market. So not really firing the big bazooka, but over time, I think it will have to take action to stimulate its economy, and that should benefit South Africa, and especially South African equities. So I touched earlier about the speculative parts of the markets and what seems to be really in a bubble. So if we talk about crypto, this is the Bitcoin price. It's gone over the space of a year from 17,000 to 46,000, and really the last spurt was the fact that the SEC allowed mutual funds in the US to invest in various cryptocurrencies. But not everyone is a believer. On the left here, you have the late Charlie Munger, long-time partner of Warren Buffett in Berkshire Hathaway, who was quoted some time back as saying Bitcoin is a disgusting asset class and bad for civilization. So you have these two contrasts. I think there's a wave of new money trying to invest in this speculative asset class, and then maybe the more traditional investors who tend to steer away from it. And I think we tend to be more traditionalists in terms of how we look at investment and how we invest. So to round up this presentation, I mean, what's likely to drive up markets in this year, 2024? We've spoken about economic growth, whether we're going to have a no landing, a soft landing. I think that's a key issue. the path of inflation, and how that's likely to benefit bonds as an asset class. The other thing is geopolitics. I think apart from the wars which are raging, I think elections is going to have quite a big impact on sentiment. We've already had the Taiwan election early in January, and it's the party who's more of a one about independence, which won at the polls. Again, there's always concerns that might lead to more friction between China and Taiwan. We have our own South African elections where the ruling party might lose majority mid-year, and obviously you see the primaries raging in the US with Donald Trump winning New Hampshire and likely to be the Republican candidate and have a rematch, Trump versus Biden. That's November 24. And we've seen the impact of a Trump government, which is seen to be very pro-big corporates. And that's likely to reassert itself if you were to win the general elections. These are very difficult things to predict, but it's one we're keeping an eye on. So in terms of wrapping up, in terms of what we've said in terms of asset allocation, we think in a world where there's likely to be a soft landing and a slowdown, this is where bonds provide the diversification and cushioning effect in a multi-asset portfolio. Yields have gone up quite a bit from what they were, and they're very attractive in South Africa at 11% and in the US at 4%. So you're getting compensated for inflation and getting a real return. So a risk-adjusted basis, we like bonds, especially locally and to some extent also offshore. We don't think that the markets will fall off a cliff. We see pockets of value, definitely in local equities, which have underperformed, and in parts of the world, away from the more expensive section, for instance, of the US market. Cash, problematic because rates are likely to come down from the middle of the year. So while cash rates now high, that's likely to come down substantially. So that's one which we would use as a source of funding. So that's all. I mean, I think it's been a eagle's eye view of the world. And if you have any questions, you can always ask Steve, and he will put you in touch with me and the rest of the team. Thank you.
Thanks, Patrice. I think there is just one question. Just in light of the interest rate cycle, and many central banks, considering cutting rates this year, obviously many debating by how much. What are your thoughts with regards to that? And how are you positioning your portfolios in view of that?
A very good question, Steve. I think it's a very interesting question because if you look at what the markets were discounting, even last year, there was an expectation last year that we would face a recession and that the Fed would be forced to cut rates from the middle of last year. And even now, there seems to be this view that inflation has been conquered and that the Fed would cut rates as early as the first quarter of this year. We're not in that movie, and I tell you why. While headline inflation is coming down quite aggressively, I mentioned the 3.4%. Core inflation is higher. Core inflation excludes the more cyclical elements, and within that, for instance, rental inflation is quite high in the US. I think that will take a bit longer to come down, and I think the Fed would not be too hasty to want to cut rates unless it feels that basically core inflation is under control. And similarly, our own Reserve Bank will take its cue from what global developed market central banks are doing before cutting rates. So the implication of that is inflation is coming down, interest rates are coming down, but probably not as aggressively as what the market expects, but it's still We still see that happening in terms of middle of the year. We just feel that at this point in time, there's still value in pockets of the equity market, especially locally and outside of the US. As one, we think bond markets offer you very good compensation at this level. And the implication of that is markets are forward-looking. So even if I'm saying to you middle of the year, Steve, as from your question, you can't wait for rates to be cut to say, now I'm going to deploy my money. It's too late. Markets will look 6 months or longer in advance. So if you try to time when you're going to go from cash into bonds, into equities, I think you're very likely to miss it, because market will look through that. So our view is right now it's a question of being cautiously optimistic, to think it's not going to be all fall down scenarios. The Fed will cut as soon as it's comfortable with inflation. That should play out through bonds first, and then maybe equities might have a second wind. So that's the way we think about it. So that's why we favor bonds, both in our local and global portfolios.
Thanks, Patrice. I think that brings us to the end of today's session. Thank you very much for attending. I hope you found the content valuable. And look out for our email, which will include a link to the recording of today's presentation, as well as a short feedback form. Our next In the Know webinar will take place towards the end of February. Isaiah Mahlanga, RMB Chief Economist and Head of Research, together with our Head of Fixed Income, Albert Botha, will be presenting. Thank you again. It was an absolute privilege to host you, and we look forward to having you on board at the end of next month.